Imagine handing your life savings to a man who promised you safety, a man who sat on government advisory boards, a man whose name was etched into the walls of Wall Street itself, a man who for decades delivered returns so steady and so reliable that other investors quietly wondered, is this even possible? The answer was no. It was never possible because the money was never there. What Bernard, a former stockbroker, self-made financier and chairman of the Nasdaq Stock Exchange had built was not a portfolio. It was not a strategy. It was a fiction. A $65 billion fiction constructed with nothing more than forged documents, blind trust, and the most dangerous weapon in the world of finance, a good reputation. This is the story of how one man deceived thousands of investors, evaded regulators for decades, and orchestrated what remains the largest Ponzi scheme in the history of the United States and perhaps the entire world. If you want to understand how money, power, and deception really work behind closed doors, you are in exactly the right place. Subscribe to the Scandal Archives and turn on notifications so you never miss a story like this one. Now, let's go back to where it all began. Bernard Lawrence Madoff was born in 1938 in Queens, New York. He grew up in a working-class Jewish family during an era when Wall Street felt like another universe. Distant, privileged, and almost impossible to enter unless you were born into it. Madoff was not born into it. He beat his way in. In 1960, at just 22 years old, Madoff founded Bernard L. Lupin Madoff Investment Security with $5,000 he had saved from working as a lifeguard and installing sprinkler system. $5,000. That was the seed of what would one day be described as a $65 billion fraud. In the beginning, the firm was legitimate. It operated as a penny stock broker dealing in smaller, cheaper stocks that the major exchanges had little interest in. But Madoff was sharp. He was innovative. He embraced new technology at a time when most brokers were still doing business on paper, and his firm was among the first to adopt electronic trading systems. That foresight helped him become a founding member of the Nasdaq Stock Exchange. He later served as its chairman. The man was not just respected on Wall Street, he helped shape it. By the 1980s and 1990s, Bernard L. Madoff Investment Securities had grown into one of the most powerful broker-dealer firms in the country. In the year 2008, the year everything finally collapsed, the firm was the sixth largest market maker in S&P 500 stocks. Madoff had built a legitimate, thriving business on one side of the operation. Quietly, invisibly behind closed doors on the 17th floor of the Lipstick Building in Midtown Manhattan, there was another side. And that side was built entirely on lies. The asset management division of Madoff's firm was where the fraud lived, while the brokerage side operated with a public profile, executing trades, making markets, staying visible. The investment advisory arm was deliberately kept in the shadows. Madoff never advertised it. He never welcomed outsiders in. He operated it with a secrecy that, looking back, should have been a glaring red flag. Instead, it made him seem more exclusive, more elite, more desirable. Investors were not recruited, they were invited. Clients came through word of mouth, through country clubs, through synagogues, and through personal connections. If you were lucky enough to be offered a spot with Madoff, you took it. You did not ask questions. You did not demand to see the mechanics of how it worked. You were grateful to be there. And the dents Madoff delivered were extraordinary in their consistency. Not spectacular. He was too clever for that. Spectacular returns draw scrutiny. Madoff's returns were steady. Reliable's returns were steady, reliable. Year after year, in bull markets and bear markets alike, clients received statements showing gains of around 10 to 12% annually. When the markets crashed, Madoff's clients barely felt it. When other investors lost sleep, Madoff's clients slept fine. That alone should have raised alarm. No legitimate investment strategy produces perfectly smooth returns across all market conditions. None. The mechanics of the scheme were deceptively simple, which is perhaps why they endured for so long. New investor money was used to pay returns to existing investors, so no actual trading was happening. There were no real investments. The account statements received were fabricated. The trades listed on those statements never took place. It was a paper empire, sustained entirely by the constant inflow of new money. And and the unshakable faith of the people who trusted him. And the family was involved. Madoff employed his brother Peter Madoff as Senior Managing Director and Chief Compliance Officer. Peter's daughter Shana Madoff served as the firm's rules and compliance attorney. His sons, Mark and Andrew Madoff, also worked at the firm, though they claimed and investigators later found reason to believe that they were kept entirely separate from the fraudulent investment advisory side of the business. There were people who suspected something was wrong. There were voices who tried to raise the alarm. But on Wall Street, when a man like Madoff is involved, suspicion is not always welcome. A financial analyst named Harry Markopoulos is perhaps the most notable figure in this part of the story. As early as 2000, Markopoulos had concluded mathematically that Madoff's reported returns were impossible. He ran the numbers. He modeled the strategy. He came to one of two conclusions. Either Madoff was front-running, using his brokerage position to illegally trade ahead of clients, or it was a Ponzi scheme. He brought his findings to the Securities and Exchange Commission not once, not twice, but multiple times over nearly a decade. The SEC investigated Madoff's firm multiple times, and multiple times they found nothing. Or rather, they failed to find what was right in front of them. Madoff was skilled at deflection. He was a former NASDAQ chairman. He was known and trusted. When regulators came, he gave them enough to satisfy their curiosity without giving them anything that would expose the truth. The investigations came and went. The fraud continued. If you are still watching at this point, drop a comment right now that says "I see it," because this is the moment in almost every financial fraud story where the signs were all there. And yet, the machine kept running. Let's keep going. By the 2000s, Madoff's scheme had grown to a scheme that was almost incomprehensible. Hedge funds known as feeder funds were funneling billions of dollars into his operation from clients around the world. Wealthy individuals, charitable foundations, university endowments, pension funds, all of them were channeling money to Madoff, many of them unaware they were all invested in the same place. The total amount shown in client accounts, including fabricated gains, eventually reached nearly $65 billion. Let that number settle for a moment. $65 billion. The actual cash that had been deposited by investors was far less. But through decades of invented returns, the numbers on paper had compounded into something monstrous. And there was nothing behind those numbers, no assets, no portfolio, just a ledger of lies. The scheme did not unravel because of a regulator. It did not unravel because of a whistleblower or an investigative journalist. It unraveled because the global financial system itself began to crack. In 2008, the world entered one of the worst financial crises in modern history. Markets collapsed, credit froze, fear spread, and investors who had previously been content to leave their money untouched suddenly needed it back. Redemption requests poured in from clients trying to cover losses elsewhere. Madoff faced withdrawal demands of approximately $7 billion. He had, by his own later admission, approximately $200 to $300 million on hand. The math was catastrophic. The fiction was over. On December the 10th, 2008, Bernard Madoff called his sons Mark and Andrew into his apartment and told them the truth. He confessed that the asset management business, the business they had worked near for years without knowing, was a fraud. That it had always been a fraud. He described it in his own words as one big lie. His sons did not protect him. The following morning, they contacted a lawyer, and that lawyer contacted federal authorities. On December 11, 2008, agents from the Federal Bureau of Investigation arrived at Madoff's apartment on the Upper East Side of Manhattan. He did not deny what he had done. Confessed immediately, he was arrested and charged with one count of securities fraud. What followed was one of the most significant financial investigations in American history. The scale of the damage was staggering. Thousands of investors had been defrauded. Families had lost retirement savings. Charitable foundations had been gutted. Some institutions were destroyed entirely. The human toll was devastating and very real. On March 12, 2009, Madoff appeared in federal court and pleaded guilty to 11 federal felonies, including securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering and perjury. He offered no real explanation, no defense. He simply admitted to it all. During the investigation, a critical question emerged about the timeline of the fraud. Madoff told investigators that the Ponzi scheme began in the early 1990s. But a former trader who worked at the firm later admitted in court to faking trading records for Madoff dating back to the early 1970s. That revelation suggested something even more disturbing, that the investment operation may never have been legitimate at all. That from the very beginning, the asset management business had been a mechanism for deception. On June 29, 2009, Bernard Madoff was sentenced to 150 years in federal prison, the maximum allowed under law. The judge called the crimes extraordinarily evil. The forfeiture judgment against him totaled $17.179 billion. He received a lifetime ban from the securities industry. It was, in every legal sense, a complete and total reckoning. But the consequences did not end with Madoff alone. The damage rippled outward to his family in devastating ways. His son Bernard Madoff, who had been the one to report his father to authorities, hanged himself on December 11, 2010, exactly 2 years to the day after his father's arrest. He was 46 years old. His brother Bernard Madoff, who had also cooperated with investigators, died of lymphoma on September 3, 2014. He was 48. Madoff's brother, Bernard Madoff, who had served as chief compliance officer, was sentenced to 10 years in federal prison in 2012. The Securities Investor Protection Corporation trustee estimated actual direct losses to investors at $18 billion. As of the most recent recoveries, approximately $14.829 billion has been recovered and returned to victims. The search for additional funds continues. But for many of those who lost everything, the savings of a lifetime, the security of old age, the legacies of charitable organizations, no amount of recovery can undo what was taken. Bernard Madoff died on April 14, 2021 at the Federal Medical Center in Butler, North Carolina from chronic kidney disease. He was 82 years old. He never walked free again. So what do we do with this story? What lesson do we extract from $65 billion of manufactured reality? Perhaps the most uncomfortable truth about the Madoff scandal is how ordinary the mechanism was. A Ponzi scheme, named after the con artist Charles Ponzi, who put a similar scheme in the 1920s, is not a sophisticated financial instrument. It is not algorithmic. It is not technical. It is simply using new money to pay old investors while pretending the returns are real. Madoff did not invent something new. He simply ran the oldest fraud in modern finance at the largest scale it had ever been attempted. What made it possible was not Madoff's genius. It was the world's willingness to believe in him. It was the desire of investors to trust that someone else had the answers. It was the failure of regulators to follow the evidence that was placed in front of them. It was the culture of Wall Street, where reputation often substitutes for transparency, and where asking too many questions can make you seem unsophisticated. The Madoff scandal did not reveal a flaw in a complex system. It revealed a flaw in human nature itself, the dangerous comfort of certainty in a world that offers none. $65 billion, thousands of victims, decades of deception, one man, and the lie so large that even when the truth finally arrived, most people could not believe it. If this story keeps you watching until the very end, take a second right now to like this video. It genuinely helps this channel reach more people who deserve to know how the financial world really works. And if you are not already subscribed to the Scandal Archives, now is the time. This channel exists to pull back the curtain on the biggest financial crimes, corporate frauds, and economic scandals in history. Stories that shape the world you live in today. Subscribe and turn on notifications, because the next story is already waiting, and it is just as unbelievable as this one.